Welcome back to the Deep Dive. Today we were doing a hard-hitting journalistic investigation into the state of the world economy as 2025 comes to a close.
That's right.
We have gone through just a mountain of source material from the last few months.
And it paints a really volatile picture.
It really does. It's a period defined by these huge strategic shifts in global power. So our mission today is, well, it's laser-focused. We want to extract the essential insights you need to be properly informed.
You know, where the money moved, why it moved, and maybe most importantly, who was pulling the levers.
Exactly.
And we're going deep today because 2025 wasn't a year of, small tweaks. It was a year of tectonic plates grinding against each other.
Very good way to put it.
So to cut through all that noise, we're really going to look at three big interlocking challenges. First, you have the power struggle, right? The U.S. and China. And specifically, how industrial dominance became a weapon. Second, the absolutely dizzying AI investment frenzy. It's like a high-wire act with trillions of dollars at stake, all based on projections that are they're completely off the historical charts. And finally, these painful, radical economic experiments that are happening all over the globe. You've got shock therapy in Argentina. You've got resource conflicts in Africa. We want to synthesize all of it so you can see the true fragility but also the opportunity in the system.
Okay, let's unpack this. If we zoom out, what were the biggest economic themes dominating the end of 2025? It sounds like the central thesis, really, from all our sources, is that the whole anatomy of global power is shifting.
That's the core finding.
It's all about who controls the world's industrial and technological base.
It is. The biggest story, bar none, was China consolidating its position. You could almost say declaring victory in this superpower fight for industrial supremacy.
Victory, that's a strong word.
The source material is pretty stark. I mean, 2025 was the year Beijing successfully defied the Trump administration's attempt to force what they called submission through tariffs and trade punishments.
So defiance leading to victory. But how do we measure that? What's the actual scale of their industrial dominance that let them just withstand that kind of pressure?
It all comes down to raw industrial scale. We're calling it the industrial chokehold.
A chokehold.
Think about it this way. China's share of the world's manufacturing value added, it now exceeds 1/3.
Wow. Over 1/3.
Just let that sink in for a second. Every finished product, every component, every single piece of machinery made anywhere in the world, more than $1 in every 3 traces back to a Chinese factory. That scale gives them immense leverage.
Right. So they can dictate terms, they can disrupt supply chains almost overnight, and they don't have to fear immediate retaliation.
Exactly. And this isn't about, old legacy industries. This is centered on the sectors that everyone, including all the major Western investors, are betting the future on.
Green technology.
Precisely.
Yeah.
That's the real investment nugget here. We are talking about solar panels, wind turbines, electric vehicles, the absolute pillars of the green transition.
And their control there is what?
Across those 3 pillars, Chinese firms supply anywhere from 60 to 80% of the raw materials, the critical components, and, often the finished goods themselves globally.
60 to 80%. So if you're a European or American car maker, your entire EV roadmap is basically dependent on China's goodwill.
On their continued and maybe capricious cooperation.
Yes.
And their edge isn't just in making cheap parts anymore. It's in the foundational knowledge. It's in innovation.
Right.
They're cementing their lead not just for today, but for the future. We know from research from the Australian Strategic Policy Institute that China now leads research in 66 of 74 key scientific fields.
66 out of 74. That number should be setting off alarm bells in every Western capital.
It should be.
What kind of fields are we talking about?
Things like computer vision, which is fundamental for AI and robotics. Grid integration, which you absolutely need to manage renewable energy flows if you control the knowledge that underpins those future systems.
Then what does that mean for a U.S. firm trying to get a patent or build new infrastructure?
It means the entire economic battlefield is tilted. It's not just about producing cheap goods. They're controlling the intellectual property, the foundational research. And that lets Beijing turn that economic weight into raw geopolitical power.
By weaponizing that dependency.
Exactly. The sources explicitly point to China's restrictions on rare earth exports. It was a deliberate, tactical demonstration of this power. They're telling the world, we can and we will leverage your reliance on us whenever it suits our strategic goals.
Which brings us right to the U.S. strategy.
Yeah.
The failed strategy. The tariffs. The analysis we've seen suggests Trump's whole approach was flawed from the start. Says the tariffs played directly into Mr. Xi's hands. Help us understand that. How did a punishment that was designed to weaken China actually end up giving them an advantage?
It was a failure of what you might call comparative resilience. The tariffs definitely inflicted pain, no question.
Sure.
But the sources argued China was just structurally better equipped to endure that pain. Chinese firms are used to operating in much harsher, much less predictable conditions than their Western counterparts.
And of course, the political system is completely different.
That's the most important point. China isn't a democracy. The government doesn't have to worry about election cycles or public pressure in the same way. It can just instruct its economy to absorb shocks, to redistribute losses, and to keep strategic sectors running for far longer than a market-driven economy can.
Right, where stock prices and consumer confidence can bring a government down.
Exactly. So the U.S. inflicted pain, but China was just built to outlast it. And in the process, it probably united their domestic population against an external aggressor.
So what was the alternative then? What was the missed opportunity for the U.S.?
The recommended alternative was strategic multilateralism.
So working with allies.
Right. Coordinating a commercial encirclement of China. That would have meant the U.S. integrating more deeply with Japan, South Korea, the EU, building resilient non-Chinese supply chains for critical tech.
But that's not what happened.
No. The political reality documented in the sources is that President Trump preferred these big bilateral punishments. He ended up alienating those potential allies with his own tariffs. He basically undermined the very strategy that was needed for long-term competition.
And that handed China a short-run advantage because America and its allies just can't decouple that quickly on their own.
They can't. And this high-stakes game has these devastating implications for security in East Asia. I mean, think about Taiwan. If China chose to throttle Taiwan, the sanctions that are supposed to force them to back off could trigger reprisals.
Like blocking access to vital components.
Exactly. And the industries and the citizens of U.S. allies might find that pain just too much to bear. And that fragility pushes those allies into this really difficult balancing act.
South Korea is the perfect case study here, isn't it? Desperately trying to modernize while balancing these two massive powers.
South Korea is truly caught between a rock and a hard place. They're still dealing with the fallout from their own major political crisis.
The trial of the former president, Yoon Suk-yeol, for insurrection.
Right, after he tried to impose martial law last year. So the current administration, under President Lee Jae-myung, is operating in this much lonelier, harsher world where America is seen as increasingly fickle, potentially unreliable.
And you see them hedging their bets constantly. I mean, domestically, public opinion is strongly anti-China.
Very.
Because of past boycotts from Beijing, fishing disputes, all of that, which forced President Lee to tone down his pro-China rhetoric. But economics often wins out over sentiment.
That's the tragic trade-off. When the U.S. trade wars put pressure on South Korean industries, what do their big firms do? The car makers, for example. They're forced to choose the safer American consumer market.
But here's the critical security calculus that must haunt them.
It absolutely does. A former conservative advisor noted that if a future Trump administration were to withdraw the U.S. defense perimeter in Asia, effectively abandon them, the consensus in Seoul is that South Korea would have no choice but to get closer to China.
Just for pure survival, why antagonize your massive, powerful neighbor if the American protection is gone?
Exactly. It shows how the political fickleness of U.S. policy is actively forcing a crucial ally to prepare for abandonment. It's pushing them closer to Beijing no matter what public opinion says.
The instability created by U.S. domestic politics is directly reshaping the economic map of Asia.
And that instability is the common thread here. We see that geopolitical fragility in East Asia, but we see a corresponding financial fragility driving trillions of dollars of investment all over the world.
That's a perfect transition because the capital markets seem to be living in a completely different reality from the geopolitical anxiety we just discussed. So let's shift gears to pure finance, the AI boom. This wasn't just a trend in 2025. Our sources are calling it an investment frenzy not seen for a generation. What are the staggering figures that define this new AI bubble, and how do they signal risk?
The figures are, and I don't use this word lightly, unprecedented, which is exactly why the veterans are sounding the alarm. Let's just take OpenAI.
The company that really kicked all this off with ChatGPT.
Right, a product now used by something like a tenth of the world's population. They are projecting yearly revenue to hit about $200 billion by 2030.
200 billion. That's a tenfold increase from where they are now.
A staggering increase. But, and here's the catch, to get that revenue, they are committing to $1.4 trillion of spending on computing power.
Wait, say that again? $1.4 trillion in spending to reach $200 billion in revenue 5 years from now. That doesn't sound like a business plan. It sounds like a colossal all-or-nothing bet.
It is an absolutely speculative bet. The risk is existential. And we should slow down and really unpack why this financial structure is so dangerous. A big part of that $1.4 trillion is being financed through these complex circular deals.
Okay, circular deals. That's a huge red flag. Explain that for the listener. How does that work, and why is it a classic symptom of a bubble?
So, in short, it means the investment money just goes around in a loop. For example, a big hardware supplier. They might invest money into OpenAI.
Okay.
Then OpenAI immediately turns around and commits to spending an even larger amount of that cash back with that same hardware supplier to buy chips or computing time.
So you're creating these massive revenue projections on paper, but the money's just moving around inside a closed ecosystem.
Precisely. It inflates the apparent size of the market and its growth potential, but it masks the real organic demand from outside that little ecosystem.
Which means the growth is incredibly conditional. So if the actual market growth falls even slightly short of those unprecedented projections,
the sources warn the firm will probably go broke
and halt the entire boom. The whole circular financing structure just collapses in on itself.
Exactly. The growth rate they need to sustain this has no historical precedent. We're not talking about hitting, 80% of your targets. We're talking about a trajectory that assumes the entire global economy reorganizes itself around this one technology in 5 years.
If that doesn't happen, the whole thing goes bust.
Right. And this massive need for capital is pushing these tech titans, who used to be happy in the private markets, toward the public. They're looking for cash through these rumored mega IPOs.
They have no choice, right? We're hearing talk of SpaceX targeting a, frankly, astronomical $1.5 trillion valuation.
$1.5 trillion, then OpenAI, $500 billion, and Anthropic, a competitor, at $180 billion.
And they need these funds for massive physical projects. Starship, that trillion-dollar AI infrastructure.
And they have to go public because the private well has run dry. Global private assets under management have basically plateaued at around $20 trillion since 2021.
So private money hits a ceiling, forcing these capital-hungry giants to go to retail and institutional investors. But the public markets, they tend to care about things like, profits.
Yes.
How do these IPO candidates stack up on that profitability hurdle?
Well, this is where you see the uncomfortable trade-off between ambition and reality. SpaceX is the relative success story here.
The rocket company.
Right. It's thought to be profitable, turned its first profit back in 2023. But even with profits, it has these huge corporate governance headaches related to Elon Musk.
The unpredictability, the leveraging of company assets for personal interests.
A general disregard for traditional board oversight, all of it. And those governance issues, they create extreme uncertainty for investors. You're essentially betting on one very mercurial individual.
And if his personal or political controversies start to affect contracts with, say, NASA or the Department of Defense,
that $1.5 trillion valuation could evaporate overnight.
Okay, so now contrast that with the AI firms, OpenAI and Anthropic.
For them, the numbers are genuinely frightening. They are cash burners on a spectacular scale.
How bad is it?
OpenAI expects a net loss of around $12 billion this year. Projections show it burning through $115 billion before it even hopes to become profitable in 2030.
$115 billion in losses.
Anthropic is in a similar boat, just slightly smaller scale. They basically need public investors to fund half a decade of massive losses while they race toward a highly speculative future.
Here's where it gets really interesting, because financial history loves to repeat itself. With all this exuberance and cash burning, what are the market sleuths saying? The professional short sellers.
The veterans, the people who make their living spotting bubbles and fraud, they are unified in their warning. We're talking about figures like Jim Chanos,
the man who predicted Enron's downfall.
The very same. And Carson Block, who exposed the fraud at Sinoforest. Andrew Left, known for his work on Valiant. They're all seeing the same danger signs.
Chanos is famously bearish. He sees exuberance similar to 2021 and even compares it to the dot-com bubble. What's the specific image he used that really captures the absurdity of this cycle?
He says we've reached the data centers in space stage of the cycle.
Data centers in space.
Yes. He's referring to serious plans being floated by SpaceX, Blue Origin, and others to launch computing clusters into orbit to solve cooling and power problems on Earth.
And for anyone who lived through the dot-com bust, that phrase is like a siren call from 1999.
Exactly. It's the point where ambition completely detaches from financial and engineering reality. It usually comes right before a major correction.
That analogy alone tells you everything you need to know. Block is a bit more measured, surprisingly.
He is. He notes that the firms with high valuations still generally have solid earnings growth to back them up, for now. But Left sees the danger. He says the market is too thick and the technology is too exciting for an immediate crash, but that a major deflation is coming when the cycle inevitably turns.
And that downturn could have huge consequences for the average person.
A critical vulnerability. The sources show U.S. household stock ownership is at a record high.
Right, that's the second major worry. The public is more exposed than ever.
Dramatically so. Stock ownership is now over 30% of U.S. household total assets. That surpasses the dot-com peak, which was 27%.
So the public is highly exposed, and Chanos estimates that retail traders, the ones on the apps, have piled into the riskiest assets. They're way out there on the risk spectrum.
Which means when the correction comes, it's not just going to hit hedge funds. It's going to hit retirement accounts and family savings.
So what's the definitive signal? What's the thing to watch for that tells us this AI boom is truly over?
They all agree the real sign will probably come after the share prices have already peaked. Chanos thinks weakness will emerge after the fact.
For example,
Maybe canceled cloud computing orders. Or just a simple failure to turn all this tech promise into scalable, reliable profit. Left agrees. He says the main sign of a long bear market would be when these cash-burning firms start cutting spending, or when tech leaders have to publicly admit that AI has not been transformational for their bottom line.
and there's a hidden risk here, isn't there? It's not about valuations. It's about the financial investigators themselves, the regulatory factor.
That might be the most chilling detail in this whole analysis. The Justice Department ran this wide-ranging criminal investigation into short selling back in 2021.
And it targeted firms like Carson Blocks and even brought charges against Andrew Left.
Right. Block called it a really large, cold glass of water in the face. It forced him to think about shifting away from actively sniffing out fraud.
So why does that matter to the average investor? Why should they care?
Because short sellers, as much as people hate them, are a crucial part of market integrity.
They're the canaries in the coal mine.
They are. They find the fraud that regulators often miss. So if the government targets them and chills their activity, you risk having fewer eyes looking for malfeasance in the next boom. The Enrons and Sinoforests of the AI cycle could stay hidden until the system is already collapsing.
So when the optimism finally fades, there will be fewer independent voices watching the books. A terrifying thought.
It is.
That analysis of market risk is a great setup for our next section, which looks at the global economy's, well, its laboratory.
Right.
Places taking on radical economic transformations or caught in resource wars. Let's start with Argentina.
Okay.
The world was watching President Javier Milei's free market reforms in 2025. Did his chainsaw approach actually pay off?
He definitely stuck to his promises.
Yeah.
He had this almost religious zeal for fiscal austerity, even though it inflicted incredible pain on the population.
He got rid of price controls, slashed state spending.
Ditched subsidies. And his persistence worked just enough to stabilize the immediate crisis. And critically, his seriousness earned him a $20 billion lifeline from America. That helped him avoid a total financial collapse.
So that was the first step. But the persistent problem in Argentina is always hyperinflation and the overvalued peso. What was the latest move to try and fix that?
The latest step, and this was a signal to the IMF and global investors, was loosening the peso's exchange rate band.
Okay, what does that actually mean?
Historically, the peso was only allowed to weaken within a really narrow band, maybe 1% a month. But that was way too slow, given the actual inflation rate.
So what's the new formula?
The new rule allows the band to widen by 1% plus the current monthly inflation rate. So with inflation at about 2.5% monthly, the peso can now weaken by 3.5% each month.
It's a cautious step.
Very cautious. It's designed to let the peso, which everyone agrees is overvalued, depreciate faster without causing a market panic. And it helps with the crucial goal of building up foreign reserves.
And the markets liked it.
They did. Argentine stocks and dollar-denominated bonds both jumped. It confirmed investor confidence that the government might finally be ready to return to global capital markets.
But the journey is far from over.
Not at all. The peso is still likely overvalued, and the central bank still hasn't announced a clear inflation targeting program. So they're on the right path, but it's an incomplete one.
And we have to note, the latest data still shows CPI inflation in Argentina at a staggering 41.7% year on year. The depth of the challenge is just immense.
The price for freedom from subsidies is very painful.
Okay, from the southern cone, let's go to the heart of Africa, to the critical minerals that fuel the tech and green transitions we were talking about. The U.S. is fighting a fierce battle in the Democratic Republic of Congo to break China's stranglehold on these resources.
It's basically a 21st century scramble for Africa, but with economic tools instead of military ones.
And how did China get such a dominant position there in the first place?
Through aggressive long-term deals. Back in 2007, China signed a massive deal that gave their miners sweeping tax breaks, some of them lasting until 2040.
And that resulted in them controlling
What? An estimated 80% of Congo's mining output. That includes huge amounts of cobalt and other critical battery inputs.
So the Trump administration's response was this Strategic Asset Reserve Deal, the SAR. What is it, and how does it work as a block against China?
The SAR is an explicit strategy to block China's expansion. It requires the DRC government to commit its most promising new mineral finds. Sites like Monono, which has huge lithium potential, and Rubaya, which supplies 15% of the world's coltan.
Which is key for cell phones.
Exactly. It requires them to reserve those finds for exclusive access by American investors or allies. The goal is simple: secure U.S. supply chains and choke off China's project pipeline in Africa.
It sounds powerful on paper, but the investigative angle here suggests these deals are built on quicksand, a mix of corruption and active military conflict.
They are absolutely rife with danger. First, corruption is everywhere. Companies involved in Congolese mining are constantly facing bribery charges. Glencore paid over $1 billion in fines for bribery at just one copper mine.
And the second risk.
More critically, the deals rely on a level of political stability that just doesn't exist. Neither the U.S. nor the DRC government can guarantee security on the ground.
We see the term M23 rebels in the source material. Who are they, and why are they such a threat to these U.S. interests?
M23 is a major armed rebel group in the resource-rich eastern DRC, and crucially, they're backed by neighboring Rwanda, which creates this complex proxy conflict.
So they're not just a local militia.
No. And several of the key assets that America is eyeing under this SAR deal, including the vital Rubaya mine, are currently controlled by M23 forces.
So the deals are basically worthless until there's peace.
They're contingent on a peace that is nowhere on the horizon. Mr. Trump's prioritization of profit-making above all else is colliding with the brutal reality that you can't have supply deals without security. It's the ultimate contradiction.
Let's turn from minerals to energy, where we see these same conflicts between climate goals and economic reality playing out in Brazil.
Brazil is a fascinating case. Despite its green stance, its commitment to the Amazon, President Lula's rhetoric, they are in the middle of a massive new oil boom.
And this is happening right where the Amazon meets the Atlantic, the equatorial margin.
It's seeing a huge influx of investment, potentially $52 billion. And it could create up to 350,000 jobs.
And I noticed that local support for this controversial drilling is on the rise.
It is. The promise of jobs and economic stimulus has swayed public opinion. Approval for oil prospecting there jumped from 26% last year to 42% now.
So for local communities facing hardship, the immediate economic need outweighs the long-term environmental concerns.
It really does.
And speaking of contradictions and pragmatism, we also saw Western car makers pulling back from their ambitious EV timelines.
That retreat is a major calculated risk. The original goal to eliminate petrol cars by 2035 is faltering. High upfront costs for consumers, not enough public charging, confusion over subsidies. So, in response to pressure from Germany and Italy, the EU adjusted its rules. Now it's a 90% emissions cut by 2035, not an outright ban.
So they're giving themselves some breathing room. But what's the long-term industrial cost of that pause?
The sources warn it risks handing Chinese brands an unassailable lead in the long run. Chinese brands already have almost 11% of the Western European electric market.
And their plug-in hybrids are surging?
They are. And critically, those hybrids often aren't subject to the new EU tariffs, which gives them this unfair cost advantage. So they're capturing market share, while Western firms dither.
Short-term relief in the West comes at the cost of long-term competitiveness against China. It echoes the themes we started with.
It all comes full circle.
This brings us squarely to the future of labor and skills. If AI is going to disrupt the white-collar world, the world of bits, where are young people turning? We're seeing this growing lack of confidence in higher education among Gen Z.
And that lack of confidence is fundamentally about economics. The average cost of a 4-year public university degree in America, it's more than doubled in the last 30 years, even after you adjust for inflation.
It creates a crippling debt burden.
A crippling burden combined with this widespread anxiety that AI will replace the very entry-level white-collar jobs that graduates are supposed to get.
So the value proposition of college it's collapsed.
Dramatically. Only about a third of American adults now think a university education is very important. That's down from 3/4 in 2010.
So the skilled trades have had this renaissance as the obvious AI-proof alternative, the people who actually build the physical world.
Absolutely. The career path is clear, it's well compensated. Take the example of Jacob Palmer, an electrician. He recognized the debt trap early, dropped out of university after a year.
Smart move.
He did a 2-year apprenticeship, started his own business in 2024, and now he expects to make $155,000 in revenue this year.
And his logic is perfect. He gets paid well to learn, and AI can't wire a building. As he put it, I'll be wiring those data centers, right?
It perfectly encapsulates the current economic reality. You're either building the physical infrastructure for the AI, or you're worried about being replaced by it. And this trend is driving new education models that bypass that traditional debt-fueled route.
Like the explosion in degree apprenticeships.
Exactly. BAE Systems in the UK, the arms manufacturer, takes in over 5,000 trainees a year. Some are degree apprentices who work 4 days a week on, fighter jet cockpits and spend the 5th day in class.
So they earn money, get skills, and get a degree, all with no debt.
And demand is through the roof. BAE got over 31,000 applications for just 1,100 spots.
And America is adopting this model now, too, linking it directly back to the geopolitical competition with China.
It's a direct strategic move. The Taiwanese chipmaker TSMC, building those massive plants in Arizona, they've started an apprenticeship program.
You get local talent.
Right. They're paying for community college nanotechnology courses for apprentices like Nolan Cunningham, a 23-year-old who decided against university to avoid the debt. He said debt just cripples you.
So he went from flipping burgers to manufacturing semiconductors, debt-free.
That's the huge leap. This structure seems to be the key. You overcome the debt crisis while simultaneously creating the skilled workforce America needs to compete.
The lesson seems to be about permeability, right? Making it easy to move between academic and vocational paths.
That's what successful countries like Switzerland do. You avoid creating dead-end silos. You create highly skilled workers who aren't financially burdened.
So from the skilled trades building the infrastructure, the atoms, let's look at the innovation hubs where that hardware is being designed. Silicon Valley is all about bits, software. But we're seeing the rise of El Segundo, California Gundo as a hardware hub.
Gundo is America's bottom-up attempt to win the high-tech arms race against China, specifically in hardware. It's a modest-looking place, only 17,000 residents.
But it's become this fiercely competitive hub for engineers focused on tackling difficult physical problems. The atoms, not the bits.
And that geography matters. It's cultivating a distinct pro-American hardware culture, and it's backed by VCs like Peter Thiel, who prioritize national security and foundational tech.
And what kind of atoms are they working on there?
Really hard stuff, like enriching uranium for the small nuclear reactors you need to power massive AI data centers. They're focused on defense, space, energy technologies with real physical consequences.
And the culture there is intentionally different from Silicon Valley.
Very different. A lot of these startups have these old school industrial names like General Matter or Metal Cross. They're consciously distinguishing themselves from the software dilettantes.
And it's fueled by engineers from SpaceX and Palantir.
A powerful diaspora. They left those companies, cashed in their stock options for millions, and became founders themselves. They have the capital, the expertise, and the motivation to tackle hardware at scale.
So if AI is the brain of American tech, Gundo is trying to be the industrial muscle, the stable energy and the firepower. And they're excited about President Trump's push to revive American manufacturing.
They are, particularly in high-tech defense and energy. The hope is that this bottom-up cluster can build the bones of a manufacturing base that could be scaled up fast in a crisis.
That's a powerful idea.
One of the co-founders of a firm there, Varda, he compared SpaceX's reusable rockets to Andrew Carnegie's railways. building the foundational infrastructure so others can ship the oil or the next great innovation. It's a return to real industrial ambition.
Before we get to our final synthesis, we need to touch on the broader chaos that defined the end of 2025. It really underscores all this fragility we've been tracking. Outside the economy, we saw humanitarian crises and institutional erosion.
The world was just violently unstable. In Sudan, the civil war got much worse with the fall of al-Fashir. The RSF went on a brutal killing spree, leading the U.S. to formally accuse them of genocide.
A crisis that displaced millions.
And the conflict in the eastern DRC, where the U.S. is trying to get those minerals, that escalated significantly. The city of Goma fell to the M23 rebels backed by Rwanda,
Creating the very instability that makes those mineral deals unviable.
exactly. And even America's attempts at peacemaking were faltering. The truce between Israel and the Palestinians remained incredibly shaky. The plan for post-war Gaza just stalled.
The second phase, with the International Stabilization Force, just never happened.
It hasn't materialized. Hamas reasserted control, and critically, no country has pledged troops for that force. Regional officials were complaining they hadn't heard from the White House since October.
And now the administration's focus seems to be on building these small planned communities in Gaza.
Housing about 1% of the population. Many see it as a tacit admission that the larger plan has failed, just prolonging the misery for 2 million Gazans stuck in limbo.
And while all that was happening, the political landscape in Western democracies was just as chaotic.
Absolutely. In the UK, Prime Minister Starmer and his Chancellor were polling as among the most unpopular ever, with the populist right Reform UK surging. In Europe, you had German Chancellor Friedrich Merz taking the dramatic step of loosening the country's revered debt brake.
Explain the debt brake for the listener.
The debt brake is a constitutional rule in Germany that severely restricts the government's deficit. It's a core symbol of fiscal conservatism.
So loosening it is a huge deal.
It's a huge deal. It signals that Europe is facing such acute defense challenges from Russia, and with the potential withdrawal of U.S. commitment, that fiscal prudence has to be sacrificed for geopolitical necessity. It's Europe realizing it has to rearm itself fast.
And this erosion wasn't just strategic. It extended to institutional integrity itself.
And this is critical for the future health of global markets. European decision makers have been criticized for eroding checks and balances, for bypassing rules under the guise of urgency,
Using crises to justify overriding procedures.
which creates dangerous tools that illiberal forces will happily inherit and exploit later. We're even seeing institutions like universities and banks getting criticized for drifting into political battles instead of focusing on their core missions.
This loss of institutional restraint.
That loss of restraint is the key vulnerability. When non-political bodies become politicized, they lose the trust they need to function in a crisis. It just adds another layer of instability to an already volatile world.
Finally, let's ground all this in the cold, hard data. A quick snapshot of the macroeconomic indicators for December 2025.
The data really shows the pressure points. We talked about inflation. Argentina is leading the pack with a massive 41.7% CPI inflation.
41.7.
Turkey is right behind at 38.6%, and Egypt is at 34.2%. These are economies under immense strain.
And I assume the interest rates reflect that risk.
They are massive outliers. Turkey's 10-year government bond yields are at a staggering 28.5%. Russia is also high at 14.5%.
And the currencies.
Same story. The Argentine peso is down almost 30% against the dollar this year. The Turkish lira down nearly 19%.
On the commodities front, there were a couple of big surprises that really defined the year for investors.
The biggest story is gold. It's up a huge 63.6% year on year.
A massive flight to safety.
It reflects global uncertainty, the failure to de-escalate conflicts. Investors are looking for a safe haven. But contrast that with Brent crude oil. It's down nearly 19%, trading at $59 a barrel.
So the commodity market is signaling extreme caution, fearing a global slowdown despite the conflicts.
Exactly.
And finally, let's end the data with the star performer. A little bit of resilience in all this chaos.
South Korea's KO-SPI index, despite everything we talked about, the U.S. fickleness, the China pressure, the domestic turmoil, the KO-SPI is a massive outlier. It is up 69.1% for the year.
69%.
It indicates a surprising level of economic resilience and investor belief that they can navigate this treacherous path and still deliver stunning returns.
That jump in the KO-SPI is genuinely remarkable. It really highlights that strong institutions and resilient economic foundations can deliver even amid political chaos. What an intense deep dive. We've seen China's consolidation of power, the delicate AI market bubble, and the harsh realities of resource competition.
And if we connect this to the bigger picture, the analysis really shows that national economic interests, guided by these very specific political agendas, are just superseding global cooperation. It's forcing allies and investors into a series of calculated and often perilous risks.
It's a clear turn toward aggressive national self-interest, whether you're in Washington, Beijing, or Buenos Aires.
And a deep distrust in those multilateral institutions.
The polarization is undeniable. We've seen actors willing to erode institutional checks and balances under the guise of urgency. And that erosion of norms. It's not just political theater, it's an act of vulnerability in the global financial infrastructure.
And that leads us to a final provocative thought for you to consider. We've detailed the high stakes in the U.S.-China economic fight. We've seen the massive market risk signals flashing in the AI sphere. And we've seen the rise of a populism that's perfectly happy to exploit polarization for short-term gain.
Which raises an important question.
How much longer can key economic institutions, from central banks and regulatory bodies to the corporate boards overseeing these trillion-dollar bets, how much longer can they maintain the institutional restraint necessary to prevent the highly leveraged global economy from being torn apart by the very polarization that governments are actively exploiting? The loss of that impartial institutional restraint, that might just be the greatest systemic risk of all.